Nos acompaña para ello Charudatta Shende, Head of Client Portfolio Management, Fixed Income at Candriam. Good afternoon. Thank you for joining us.
It's a pleasure. Thank you very much for having me.
Charu, in first place, given the current divergence in monetary policy between the Federal Reserve and the European Central Bank, how do you expect this to impact fixed income markets on both sides of the Atlantic?
Yeah, it's a good question, and clearly there is a divergence between the two sides of the Atlantic, with the Fed holding steady and the ECB having already started its rate cut in the middle of 2024. And we also expect that this divergence should continue a little bit, because as far as inflation data goes, the Fed doesn't seem to be having enough confidence to start cutting rates just yet, whereas the ECB should be delivering rate cuts into the second half of 2025. Now, how does this impact fixed income markets? Well, clearly, it is going to favor, in our opinion, euro duration. So euro sovereign bonds are going to benefit from the fact that the ECB has an accommodative stance, whereas on the other side, US is likely to be slightly more challenged because they're not benefiting from that support. And obviously, if we take a broader picture here, then Eurozone credit, Euro credit, is also likely to benefit from the fact that rates are going to come down. Companies are going to be less stressed in terms of the way they refinance themselves. They're going to be able to refinance at cheaper rates. The US is not going to have that advantage. And so all in all, Euro duration and Euro credit should be favored by this context. Now, just as a side note to this, there are risks to this scenario. And the clear risk on euro credit is what I saw earlier on the screen, which is tariffs and these trade wars that are taking place. Let's not forget, US and China are, of course, talking. Europe's next. And in these trade wars, there's a lot of rhetoric, there's a lot of news, and that can negatively impact European markets as well. So that is something that we really have to monitor very carefully when taking positions.
If we speak about the US and China, how are rising protectionist measures and the risk of a renewed trade war, especially between the US and China, affecting fixed income investment strategy today?
Yes. So the idea here is that these are the two of the largest economies, and the fact that they are engaging in a trade war is tough enough itself. But China, right from the beginning, has decided to take a more combative stance towards this, and that's why it has taken such an amplitude. The truth is that even though we're in a position where the two parties are discussing, we lack details as to what exactly is going to come out. Of course, we've gone from 145% closer to 40-30%, so there is a détente there, but it's still 30 to 40%, which is higher than it was 4 months ago. So the impact is going to be, of course, on inflation, which in the US is going to tend towards more elevated levels, and the Fed is clearly paying attention to that. And the impact is also likely to be on the macroeconomic side, where you probably are going to see some weakness stemming from this. Again, we're missing details. So it's the one thing we are sure about is that the biggest impact on fixed income markets, is going to be on volatility. It's going to be on gyrations. And what I was saying earlier is that these trade wars come with a lot of announcements, a lot of news, and market has to react to this in a very, very immediate manner. And so in this sort of a context, it is extremely important to be tactical, to be flexible, and to be prepared rather than try and predict, because a lot of this trade war is, the path doesn't seem to be fully clear. Is it a negotiating tool? Is it something that is here to stay? You hear a lot of things. The biggest impact is volatility, and for that you have to adopt a very flexible and a very active stance to manage it.
Flexible, practical, so difficult.
Yeah.
With inflation showing signs of persistence in some regions and slowing in others, where do you see the most attractive opportunities in the fixed income space, sovereign debt, investment grade, or high yield?
So again, as we said earlier, euro duration, euro rates, there we see quite a possibility of them moving lower. We know that inflation in Europe is controlled. We know that macroeconomic data is going to be on the weaker side, and that's going to give more incentive for the ECB to cut. So rates should trend lower in the Eurozone. But again, the Eurozone is not homogeneous as it used to be during the time of QE, right? So you are going to have a differentiation, a greater differentiation between core markets and the non-core markets. And what we see is core markets like France have deficits that are slightly more elevated, whereas non-core markets like Spain and Portugal, their deficits are controlled. And so we have to make a differentiation between this rather than just take a directional view on EU duration. And the same thing is true for European credit. So European credit on investment grade, because you mentioned investment grade, overall, things don't look bad. Fundamentals appear to be holding up, even though we have to wait and see what happens in Q2. We see that valuations are present. Investment grade is at 3.1% yield. That's still sufficient. That's good level of yield compared to the past many years. And on top of that, technicals, so the flows, investor flows, seem to still be there in investment grade even after Liberation Day. Once you had the reprieve, flows came back into the investment grade market. So from that perspective of fundamentals, valuations, and technicals, investment grade seems to be a good choice. But at the same time, again, within investment grade, there are going to be sectors like the cyclicals, like the autos, that are going to have trouble with tariffs and global economic slowdown. There are going to be other sectors that are going to benefit from it, or rather are going to be slightly more immune towards it. And it's the same for high yield markets. So what I'm trying to say is that we have a favorable view on assets like European investment grade over the medium term. We have a favorable view on euro duration. But once again, making the difference between the subcomponents, between issuers, looking at the ones that have adapted to this new world, looking at the ones that have now solid balance sheets that are geared towards deleveraging, good cash flow, those are the ones that are going to win in this context. Whereas the others, with higher debt levels and lower free cash flow, they are going to suffer. So making that differentiation is going to be extremely key. And if I may, there are significant amount of risks to all these scenarios. Let's not forget, market is pricing good news better than it is pricing bad news. And, high yield spreads, investment grade spreads, they have retraced quite a bit since Liberation Day, but the level of tariffs is still high. So all this weak macroeconomic news is going to trickle through the market, and we have to be very careful about that as well.
Charu, my last question, are there any specific sectors or geographies within the fixed income universe that you believe are currently undervalued or offer compelling risk-adjusted return amid the current macroeconomic uncertainties?
Yes, and there, as I mentioned earlier, a TMT or telecom sector, especially within the high yield market, we see that spreads are higher than most of the other sectors. Now, obviously, that sector has a little bit higher level of debt, but within that sector, we see companies that have very strong credit metrics, and those are the ones, those are the sectors, those are the names that we feel have a lot of value. On the other hand, again, it's an easy target, but the auto sector, unfortunately, is right in the middle of everything that is happening today. In terms of geographies, we mentioned the Eurozone being a favored one, but look, even the US, right? If we look at the US market in general, today, yes, we see that rates don't seem to have a lot of downside pressure. But again, if we find resolution within these tariffs, and if the term premium in US rates start coming down, then once again, there is no reason for US rates to not be an interesting proposition. It's really news dependent. Unfortunately, and that's it sounds almost silly sometimes to say, well, yes, but you look at the way market has been pricing news rather than pricing fundamentals, and you realize that every word counts. You did have a president who, back in March, I think, said, I'm not even looking at the stock market. And then later on said, well, it's probably a good time to buy. So these are moving parts. These are changing very fast. Structural view is, yes, euro duration and euro credit should be okay. Investment grade specifically has the fundamentals to carry through. But you know, these are news and flow-driven markets, so we have to be careful.
Charudatta Shende, Head of Client Portfolio Management, Fixed Income at Candriam. Thank you for joining us.
It was a pleasure. Thank you so much.
Yes.